All right, good afternoon. We are going to run through a couple of points, some refreshers on ECO and ARC and PLC, how they work, and then also the changes that were made to ARC and PLC here recently, just about a month ago, and then also how we are incorporating this information into your risk management plan. So let's look at ECO first. If you remember from insurance season, ECO was subsidized at a much higher rate this year, so we looked at it a little bit closer. The concept was that the spring price was at 470, and it was going to give us a 95% revenue guarantee. At the time, if you just assumed yields were constant, that would have given you a 446 price floor. Now, higher yields mean lower price floor because it's a revenue-based product. And so you can see on the chart down here, as county yields go up, the price that the payment kicks in actually gets lower. So let's say this county, for example, had a 207 expected yield. If they come out with a 220, that's actually going to create a lower price floor. The price isn't going to really kick in until probably closer to 420. And then they've got about half of the payment at $4 and about the rest of the payment at 380. So just an example of how that works. Our county, very similar revenue-based product. It's based on county average yields and a marketing year price that's established by the benchmark. It's a Olympic average of the last 5 years. And so as you can see, as price and yield go down, you have larger payout scenarios. As price and yield go up, you lose out on those payments. The kicker with our county is that it's maxed out at 12% of your expected county revenue. So that's why after we get down into the 340, 360 range, you see this 126 constantly. PLC, on the other hand, is a price only program. It's only based on the price of the given commodity. It's got a 442 reference price, so you can see anything under 442 is starting to pay out. Those are the difference between the two. How do they come up with those prices? How do we decide what is the marketing year average price? It's USDA came up with this idea of how farmers sell their grain. Their concept is that in September through January, farmers sell about 50%, just over 50% of their grain, and then the rest is marketed through the last 7 months of the year. So it's a little bit front loaded, but it truly is kind of a marketing year average price to where you're delivering a lot of grain at harvest and then some after the first of the year, but then it also takes into account the prices in the summertime. So it's a long average that we're going to have to calculate over the next 12 months. The biggest changes and why we've been talking about this probably more frequently, especially getting close to these $4 levels, is the changes in the big beautiful bill that got passed on the 3rd or 4th of July. So the three biggest points, after running the numbers, the three biggest points that we've noticed have the most impact are the PLC price going from 427 up to 442. That was because they raised the percentage of the ARC price that was. They raised the ARC county guarantee from 86 up to 90, so that effectively turned a 432 floor into a 452 floor. And then the biggest, in our opinion, the biggest piece of the bill that has the most impact on this year is that since they made changes to the program, they're going to allow producers to take the higher of the two programs. So if your county were to trigger an ARC payment, but you elected PLC, you're actually going to get that ARC payment even if you elected PLC at the beginning of the year. This chart below combines those two concepts. So we had the PLC where it was just the single price level, but then this is adding on that ARC concept to it. So we'll see that in our next page here when we get into that. The document that we need to get your base acre information is called the 156 EZ. It's from your FSA office and it has your base acres on corn and beans and your PLC yields. So every farm, regardless of what you actually plant on it, has a set number of base acres and a HIP. HIP is historical irrigation percentage. So we plug all of that information into this table here to come up with what payments you can expect. So anywhere that you see blue is either based on your farm or your county. So the projected yield for this specific county was 207 and 60 on the beans. Green are assumptions that we have to make now. So the ECO payout is based on the harvest price. So obviously we don't know the harvest price, that'll be the October average, But right now, the D Sport is trading 406. So we're going to plug in 406 to have it spit out that information. Same with the beans. And then final county yields. This is where you can estimate, okay, what can my county kind of expect? I'd say in most non-irrigated counties, we're figuring anywhere from 10 to 12% above trend line or above expected. Irrigated counties, probably something a little bit lower, 5 to 7% possibly. So we can plug in something like that that's based on your county and your expectations. Down below, this is the ARC and PLC information. This is where you'll plug in the base acres that we got from these other sheets. So you're going to plug in your base acres, your PLC yields, and your historical irrigation percentage. The ARC benchmark yields, those are on a tab over here. It's just published by the USDA. And then again, some assumptions. So with those same values are flowing down into this chart, we're going to figure that this county gets a 220 at the end of the day, and that their final marketing year average is 406, which is where the market is at right now. All of that said, it's giving us payments of ARC County of 56,000 and PLC of 65,000. So in this case, we would end up getting PLC payments for the year, and we would get on 950 planted acres, we would get roughly 80 bucks an acre of PLC payments. That also includes the money that we'd get from ECO, which in this case would be 30 bucks an acre. So it's only a few variables that really affect the bottom line, but we also want to know, okay, we can say that, well, maybe it's going to be 220, but what if it's higher? What if it's lower? So that's why we made these matrices off to the side. So we can calculate, okay, if the price stays around $4 and my yields come in at, call it 220, what can I expect for an ECO payment? In that scenario, I'd expect a $43 ECO payment. But if yields came in at 215, I could have $63. If they came in higher than expected, I might only get a few dollars. Same with ARC and PLC. We have the higher of the two filling in here. So you can see up in this range where it's changing, that's where ARC is kicking in. Down here, once you get into really deep price losses, that's where PLC is kicking in. So what's the sum of those two? If the market stays at $4 and we finish with a county yield of 220, I'm expecting $103 per planted acre. Now we want to make sure that's per planted acre because it's possible that you planted 1,000 acres of corn and you only have maybe 700 base acres of corn. So that's going to definitely swing the level of payouts that you can expect if your base acres are drastically different than your planted acres. We can divide that by, so let's say our whole farm average is 220 as well, to get, that's roughly a 50-cent payment per bushel on all of our production. So how do we want to take this into account with our marketing plan? If we have 50 cents a bushel of payment at $4 and we have 84 cents a bushel of payment at 380, that means that our downside protection is actually more than just a hedge would be. So this chart down here is called delta. Delta measures how much your outcome changes relative to how much the price moves. So you can see up in this chart, at $4, we're getting 47 cents. 20 cents lower at 380, we're getting 84 cents. What's the math on that? That's 37 cents of difference in payments just for a 20-cent move in the board. So what this is saying is if you have ECO and ARC County, you're actually overprotected on this downside from $4 down to 380. And it doesn't really start to level off until closer to 340 to 320. That's where PLC is then kicking in. And if we do rally from 4 to 440, then you start to have that level back off, and that would be where then you're just subject to the market again. If we combine that with your gross farm revenue, this is just a simple calculation of $4 times 220, 880 bucks of gross revenue. If we combine those two numbers, we get this outcome. So with payments, you could expect $984 an acre of revenue plus FSA payments. You can see that if we go from 4 down to 380, you actually increase your gross revenue by about $30, $40. So if we're tying that in with a marketing plan and we're 50% sold, now you're even more covered to the downside. We have a situation where at $4, If we go down to 380, you're increasing your gross revenue by close to $60, $70. If the market goes from 4 to 420, you're actually missing out on 50 bucks. So it's a situation where, because of ECO in our county, where we're right at these trigger levels, we could actually potentially be overhedged to some extent, depending on where you're at with the hedge position. So again, this is going to be totally different for each farmer, depending on their hedge position, depending on their base acre situation, depending on if they took ECO or not. And so by no means is this a one size fits all recommendation, but it's just an encouragement to get your information and have these conversations with your broker so that you can understand, okay, where am I at as it relates to these support programs that are out there, and how can I make sure that I'm not hamstringing myself if we do make some kind of run back to 450 plus levels, that I'm not, missing out on an opportunity that I'm overhedged on. So give your broker a call if you have any questions on this. Thanks for giving it a watch.